proactive engagement, and also stewardship of companies that we invest in. So we don't just believe in simply excluding companies that have poor sustainability qualities, but we actually very much believe in engaging them to actively steer them towards an improvement. And this lets us effect real positive change and also unlock investment value for shareholders. And last but not least, Fidelity is known as a research house. So research is pretty much in our DNA. We have one of the largest, if not the largest, network of research analysts. And our research analysts actually plays a very big part within our investment process and also forms the backbone of our investment decisions. And this also represents one of our largest competitive advantages. And especially when we take a look at technology investing today, you'll be able to see how we very much tap on the expertise and also the breadth of our research network to be giving us insights and research coverage in many places across tech and also across other sectors as well. So maybe let me just start off first to address why we think technology is not just a fad. We are not just having this session on technology today just to chase after the latest headlines, but in fact, this is going to be something that is a long-term opportunity that investors should continue to have exposure to within their investment portfolios. So we have seen how in history, from the steam engine of the first industrial revolution to the internet age of today, tech has pretty much transformed the way that we live, we work, and we play. And what we are seeing also is that the opportunity for technology only continues to accelerate in the modern world. So the world has already spent 3.5 trillion US dollars in the year 2022 alone. And we are seeing how this number is looked set to grow even further, with over 90% of the world's top 1,000 companies actually committing to increasing investments to build up their capabilities in big data and also artificial intelligence. And of course, the mobile phone now has pretty much become a natural extension of our everyday lives. And we have over 7.4 billion mobile users worldwide. And today, just to put that into context, the world population stands at around 7.8 billion. And by the time I finish speaking this sentence, more than 1,000 new devices, in fact, have just gotten connected to the internet. So there's also a famous concept in computer science known as Moore's Law. And this basically states that the number of transistors on chips will double every 2 years. And by extension, this actually suggests that computing power will increase at an exponential rate over time. So it's not going to be increasing in gradual steps, but in fact, Moore's Law is saying that computing power will be increasing at an exponential rate as we cross across generations. And I would say that when it comes to technology, we have likewise come to expect nothing less than exponential growth. Whenever we look at Apple's keynote event, in fact, we have one coming up in a couple of weeks' time, we have seen how with each iteration of the iPhone, improvements has always been more than just a single-digit percentage in terms of the speed of computing, in terms of the depth of their features as well. With each Apple keynote, we are seeing how a lot of the chips are actually improving their capabilities by multifolds. So I would say that just looking at this chart alone, we have seen how the time it has taken these well-known tech companies to reach 1 million users has also been coming down quite a bit. So Netflix took over 1,000 days to hit 1 million users. Facebook itself took over 300 days. Instagram took 76 days. And of course, the latest game changer to arrive on the scene, ChatGPT, took just 5 days to reach 1 million users. So the main takeaway here is really the fact that when we look at the rate and the speed of adoption of new innovative technologies, this has been happening really with unprecedented scale and also speed. So while most may also tend to fixate on the latest buzzwords and also headlines like the mega cap tech companies, robotics, e-commerce, and the latest buzzword generative AI, I would say that the key takeaway from this chart over here is how these are really just the tip of the iceberg when it comes to technology. So tech is now cutting across all industries, is increasingly becoming more embedded within our everyday lives. And this is cutting across traditional sectors as well, such as energy and also gaming, places that we have traditionally not associated much with tech innovation. So it's key really for investors to maintain a sort of broader view when investing in tech, because it's no longer just committed within the information technology sector. You are seeing how technology innovation, products, and services are increasingly cutting across all other industries as well. So this is really a multi-sector long-term opportunity for investors to consider. And I would say that the first question that may be coming to the top of your mind is whether or not it is too late to be looking at tech and whether or not investors are going to be buying in at a high. So no doubt, if we look at how the tech sector has performed, looking at 2022, that was pretty much a year where tech underperformed because of a perfect storm of rising interest rates, high inflation, and of course, elevated geopolitics. So we have seen how the latest rally in tech has been extremely strong as well. We have seen how it has clawed back quite a bit of those losses. But it's also worth noting that the latest rally has been driven by a very narrow group of just 7 mega cap tech names. So these are typically known or otherwise commonly referred to today as the FANG Plus stocks. So these are none other than Facebook, Amazon, Apple, Microsoft, Google, Tesla, and also the latest darling of the market, NVIDIA. So if I draw your attention to the chart on the right, what you can see is that the S&P year to date, one of the best performing markets, up around 18%. But more than 80% of this rally is pretty much accounted for by these 7 names alone. So on average, if you take a look at how these 7 mega cap tech giants have performed, they have performed on average 61% up year to date, while the rest of the S&P 500, so basically the 493 other stocks within the S&P basket, these have only gone up just about 6%. So it has been an extremely narrow and crowded market that has been powering this rally. So if you're concerned about buying tech at the top, I would say that not everything in technology is expensive. If you look outside of these parts of the market that has been very much crowded around these 7 mega cap tech names, there's still going to be plenty of opportunities that are trading at more reasonable and attractive valuations, and something that the more discerning investor should be able to capture. So another question also is whether or not we are in another tech bubble. So despite the rally, I would say that we don't have to look any further than just 2021. What you can see on this chart over here is that overall tech valuations, even after the very sharp rally that we have seen, have yet to recover to the highs of 2021. In fact, we still have about a cushion of around 15 to 17% in terms of valuations away from the peak back in 2021, right before the tech market really sold off on the back of elevated inflation and also higher interest rates. So I would say that it's important really to be selective, to consider the fact that if we strip out some of these mega cap tech names, valuations are going to be looking even far more reasonable, but it's going to be very important to be selective, very important to also maintain a sort of contrarian approach when navigating this extremely narrow market. So taking a step aside from the metrics and also valuation story, if we take a look at the longer term growth story for technology, this is still very much intact with many structural themes and tailwinds powering the opportunity. So 5G is something that has been playing out for quite a bit now, and we continue to see continued build out of infrastructure as we advance towards a world where mobile data speeds are becoming even faster. So AI, artificial intelligence, the latest buzzword, the latest hype, we continue to see a very strong pickup in terms of investments that companies across all industries are pumping into this space to make sure that they're increasingly integrating AI to improve their workflows, to improve efficiencies, and also deliver innovative business products and services. Next generation transport, this is really going to talk to the theme of how cars today are becoming even smarter. You're starting to see how cars are commonly now being integrated with sensors to really help your driving experience. Yeah, autonomous vehicles are also becoming something of a thing as well. And of course, the electrification theme is also well underway. If we just take a look in the Singapore market, we are going to be seeing more and more EVs on the road. You're going to be seeing more and more EV charging points as well being embedded within all the different shopping malls that we visit. Cloud infrastructure, something that is more of a broader theme. We're seeing a very strong move away from hardware storage and server farms across enterprises. And I would say that even personally, looking at how I'm choosing to store most of my data, I'm leveraging cloud services as well, and looking away from just simply parking my data onto some of those hard drives that used to be a thing just a decade ago. So the internet space continues to be something that is transforming the way that we live, we work and play, continuing to be a very important opportunity set. Digitization is something that is also going to be key to take a look at, simply because this is going to be cutting across multiple industries, like I mentioned. It is going to pretty much be transforming the way that businesses do execute their business models as well in the coming decades. And something that is a bit more of a recent theme that will be pretty much within the opportunities from China's tech build-out. We are seeing how China has been buckling down and really pumping in a lot of R&D to work towards securing self-reliance in science and technology. So I'll say that what you can see is that the tech story is pretty much well and alive, and it's going to be divided across opportunities in the shorter term, in the medium term, and also longer term structural growth factors that are not going to be going away anytime soon. So I would say against this backdrop then, we have shared about how today's market, especially when we look at the tech sector, has been very narrow in terms of what has been leading the market higher, and where it's also important to sort of maintain a sort of contrarian approach, making sure that we are looking outside of the crowd, making sure that we are looking away from some of this herding that is happening within the market, and to really look for opportunities that are trading at reasonable valuations that most may otherwise be overlooking in their personal portfolios. Let me just take the chance to share about how we are approaching tech investing within our Fidelity Global Technology Fund. So within our Fidelity Global Tech Fund, I would say that we look to deliver just four key sort of messages. And that is where we look to put the TECH in technology investing. So the T stands for time-tested approach. What we're having within our fund is not just a new kid on the block. It's not going to be taking an untested sort of approach towards navigating the tech environment. This fund has a long and strong track record. We have been able to outperform also the index and also our peer group since the fund was first incepted in 1999. So more than sort of I would say that more than a decade to two of a track record in terms of how we have been able to navigate across different market cycles. And most importantly, of course, we have been coming in the top quartile of our peer group across multiple time periods, across the shorter term as well as in the longer term. And I would say that this has really shown how we have been able to navigate different market cycles to be able to prove that we are able to be resilient and also defensive during challenging markets such as 2022, while delivering a sort of consistent return profile for investors. So the E stands for extensive investment resources, and this is going to talk to the research that is powering and backing this fund. So the fund is led by our portfolio manager, Hyun Ho, an experienced portfolio manager with more than 2 decades of investment experience. And more importantly as well, we are backing it with Fidelity's extensive network of research analysts. So like I mentioned earlier in our introduction, we are known for our breadth and also depth of research. And I would say that in the way that tech is pretty much a multi-sector, multi-thematic kind of story, this really gives us a competitive advantage because we can tap on insights of our analysts that are covering across different industries, not just within IT, but we can speak with an analyst who is covering the industrial sector, within the financial sector, just to see what are some of the latest tech innovations that may represent a very interesting opportunity within the tech space. So the C is going to talk to our investment style, our investment philosophy, and the way that we are approaching tech investing. So the C stands for how we are contrarian and very much benchmark agnostic. So when we speak about contrarian approach, I would say a very prime example of a contrarian investor would be none other than Warren Buffett. So Warren Buffett does take a very strong contrarian view. He, of course, pioneered the very famous saying about how we should be greedy when others are fearful and be fearful when others are greedy. So contrarian and moving against the crowd, being wary about herding behavior, I think this is something that is very well expressed within the portfolio. And we have a very strong valuations discipline as well, which I think is going to be extremely key when navigating the technology market. So valuation discipline means that we will not overpay for stocks at all costs. No matter how much we like a stock, we believe that it should be trading at reasonable valuations. We don't want to be buying things when they have been overly hyped up. And that is also going to be representing how we have been able to be more resilient, especially when markets are selling off, simply because we are offering more margin for safety on the downside. So another example of how we are very much contrarian is going to represent how, when it comes to the mega cap tech names that I spoke about, so the FANG Plus kind of a basket, we do carry a much more limited exposure to these parts. And in fact, we would be concentrated more within opportunities that are otherwise overlooked or under research, for example, within the small and mid-cap space. So the H would stand for a holistic portfolio construction. And this is going to represent how we take a broader view, a more diversified view towards approaching tech investing. We are not just going to be focused within finding opportunities within the IT sector. We are going to be looking outside of this. We are going to be peeking under and looking under the tip of the iceberg to really look for where are some of these opportunities outside of just these traditional sectors that people tend to focus on. And also, of course, we are going to be focused on a blend of 3 different opportunities within the tech space, making sure that what our portfolio has is giving you exposure to opportunities both in the longer term as well as in the near term. So typically, the companies that we hold would fall under one of these buckets. So they would fall under the growth, they may fall under the growth bucket, and these are going to be companies that are your long-term winners within the technology space. You would also see some cyclical opportunities as well. So more tactical sort of opportunities that we are capitalizing on. So these could be longer term names, longer term winners that may be weighed down in the near term by short-term market concerns. So for example, right now, if what we have seen is how back in the Q4 last year, there were a lot of fears of a potential recession, fears of a drop in global demand. So these are really just short-term cyclical factors that may be weighing on sentiment, and you see how there may be some broad-based selling that's happening in the market. So this actually gives us an opportunity to pick up on some of these names at very big discounts, simply because of short-term concerns, and these are actually strong businesses that will do well in the longer term. So making sure that we can capitalize on some of these shorter-term opportunities are another key feature of our fund. Last of all, something that's going to be quite interesting is how we do also participate within the special situations bucket. So this is going to be representing some of the M&A, so merger and acquisition opportunities within the tech sector. So if you have been following the tech sector, what you tend to also notice or observe is that there tends to be a trend of mergers and acquisitions happening within this space, simply because it may make more sense for a lot of your larger tech companies to just go out there and look for some of these smaller companies that are delivering a very specific innovation, and they can simply go out there to acquire some of these sort of features. So take, for example, look no further than your iPhone with the sort of Face ID technology, and back in the previous generations when Touch ID was a thing, most of these technologies would have actually been enhanced upon or built upon some of these acquisitions made by Apple when they would have gone out there to purchase some of these smaller companies that were able to move quicker simply because they were smaller, they were nimble, and acquire some of these technologies to embed within their broader product. So again, another area of opportunity that our fund is going to be looking at. So T, time-tested approach, E, extensive investment resources, C, contrarian in the way that we invest, and last of all, making sure that we offer a holistic portfolio. These are going to be the 4 key characteristics that we hope to deliver with our Fidelity Global Technology Fund. So talking a bit more about the performance and what this has been able to return for investors, what you can see is that over the past decade, we have been able to outperform both the index and peers. In fact, we have been beating over 87% of our peers within the peer group. And on the risk reward level as well, what you can see on the chart on the right is that we have been able to deliver higher returns than the broader index while delivering this with lower risk. So I would say that we have been very efficient in the way that we are managing risk, while at the same time capturing long-term returns, consistent returns for our clients as well. So looking ahead, just to put a face to the name as well. So the fund is managed by Hyun Ho, and he is the lead portfolio manager that's powering this strategy. So something that I can share also is that he did start out as an equity analyst. So what he brings with him is a very strong background in fundamental analysis, a very strong background in navigating and assessing companies from a bottom-up perspective to finding opportunities out there within the tech sector. And in fact, he has been able to amass a very impressive track record. He has been running the fund since 2013, so slightly more than a decade of being on top of this strategy and being able to outperform the peers. I would say that is really a testament to his skill in stock picking and in navigating this tech environment. And more importantly as well, if you take a look at across the industry, if you take a look at all the different tech funds that are out there, I would say another key differentiator is how Hyun Ho, he is the lead portfolio on this strategy, and he simply manages this one and only fund. So he's not going to be dividing his attention across any other funds. He is solely focused on this, and this is going to be another reason why we have been able to be hyper-focused in capturing opportunities within the tech sector. So looking at the extensive investment resources that are backing this, like I mentioned, this is going to be tapping on research and expertise across all industries, not just within the tech, what we commonly refer to as the TMT space. We are also going to be leveraging some of the analysts within the healthcare space, within the financial space, simply because if you take a look at even a traditional sector such as the banking and finance space right now, what you see is how fintech has pretty much grown to be a very strong player in this otherwise very traditional industry. So again, it's going to be very important to make sure that we are taking that sort of diverse view to capturing opportunities even outside of the information technology sector. And in fact, we do also take a sort of a yearly sort of bus tour towards Silicon Valley. And I find this quite interesting because industry conferences happen on an annual basis in Silicon Valley. And so our analysts are actually going out there, getting on a bus and really taking a tour down Silicon Valley just to meet with all the different C-suites and speaking with them to understand what is the latest innovation, what are some of the trends that they are seeing on the ground. And again, this is something that is going to be a competitive advantage for the fund that most peers will not be able to replicate if they don't otherwise have this very strong network of analysts to leverage upon. So if I speak a bit more about how we are contrarian and about how we are approaching tech sector, tech investing very differently from our peers, I would say that this slide alone would capture the 3 key differences. So looking at the first point about how most people tend to anchor themselves on the mega cap tech companies, the ones that are very much well known in the market, within our fund itself, we do run a far lower exposure. We are less concentrated within these crowded parts of the market, such as the FANG names. So within the fund right now, we have an exposure of between 17 to 19% within these very commonly held names. And I would say that again, in terms of the way that we are differentiated, we do have a more meaningful exposure within the small and mid-cap space of technology to give us exposure to some of these under-researched opportunities that people tend to overlook. So the second point is going to speak to how we are able to be looking outside of some of these headline kind of sectors to finding opportunities that are underloved, underappreciated, or under-researched. So we wouldn't just be chasing after the latest headlines. We wouldn't be chasing after the so-called latest sector to have been making the news, but we're going to be looking for opportunities even within traditional so-called old world sectors, such as energy, and also some of the other industrial names as well. So last of all, it's going to be a common question that we typically get also. People may associate technology investing with exposure to high growth stocks. And as a result of that, they feel like they may be exposed towards a higher drawdown, more volatile sort of investment journey. But I would say that simply because our fund does have a very strong valuation discipline, making sure that we are buying into stocks that are trading at reasonable valuations. This is going to be helping us to mitigate on the downside, mitigate some of the volatilities that otherwise comes attached with investing in a growth sector such as technology. So this slide would just go down to really break down for you how we are very much different in the way that we have less of an exposure towards your FANG Plus names. So for example, within Apple, within the index, this has an exposure of almost 21%. And this is going to show you just how huge some of these tech companies have grown within the overall market. And within our fund, we run an exposure of slightly under 5% right now to a very commonly held name such as Apple. Microsoft, another very big bellwether company within the index. Again, we are going to be running an exposure of just over 5%. So I would say that in terms of the way that we are concentrated within this very crowded parts of the market, again, you are going to be seeing how we are running a lower exposure, a lower concentration to this part. So within the small and mid-cap space right now, we do hold an exposure of around 21%. So again, this is going to be very different from the broader market index where small and mid-cap tends to occupy a much smaller proportion of it. And this is going to be showing you how we can capture more alpha and return more alpha for investors simply because we are taking a more off-benchmark kind of play. So another common question that we get when it comes to navigating the small and mid-cap space is the fact that how is it going to be exposing clients to more risk simply because most clients or investors may have the view that small and mid-cap space tends to be less liquid, they tend to be less research. So I would say that right now, in terms of the overall exposures at about 20%, it gives us a good optionality, it gives us a meaningful exposure, but at the same time, it's never going to be anchored or going to be the core part of the portfolio. It's just going to be a more meaningful way for us to extract alpha. So in terms of risk, that's going to be mitigated. And another thing is that what is going to be powering our decisions within the small and mid-cap space is again going to be our extensive research network, making sure that most if not all of our investment decisions within this space is going to be backed by solid fundamental research within here. So if we take a look again at the three buckets that I spoke about in terms of how we are finding opportunities within the portfolio. So within the growth sleeve, I would say that this is going to form the main part of the portfolio. So this is really going to be comprising of companies that are long-term structural winners. So some of these companies that we believe will be able to participate in some of these longer-term structural mega trends. So again, this is going to be taking a more longer-term view. And this is where we are going to be going for some of these companies that have very strong business models, that have very strong competitive advantages as well, that will help them maintain a dominant position in their respective subsectors. So another key example would be Alphabet. So Google, as we all know, is pretty much the way that we are going to look for our information today. In fact, Google, it has become a very common phrase today. And I would say that going after some of these companies that have established a very strong market position is again going to be helping us anchor ourselves within some of these long-term structural winners. So cyclical sleeve is going to be about how we are going to be finding opportunities in the near term. So for example, like I mentioned, when market is focused on short-term concerns, for example, recession fears, or shorter-term sort of market developments, this gives us an opportunity to take advantage of any sort of broad-based sell-off, to be picking up on quality names, solid businesses that have a very strong sort of a long-term business model, a business view, but they are otherwise weighed upon by these short-term concerns. So this gives us an opportunity to be sort of contrarian when the market is sort of taking risks off the table. We have the opportunity to pick up on some of these strong businesses at very material discounts, giving us much better return potential on the upside. So again, being an active fund, this is something that we want to be able to capitalize on, something that we have been able to do very well within our allocation towards the semiconductor space. So special situations, again, simply because we have a very strong research coverage within the small and mid-cap space. The small and mid-cap space is, again, going to be one of the key places of the market where you're going to be seeing a lot of merger and acquisition activity happening, simply because this is going to be an area of focus for some of your mega cap internet giants, mega cap tech companies to be looking for some of these innovative sort of solutions that much smaller companies have been able to offer and develop. So this is an optionality for the fund, and another way that we are able to capture alpha through our research and through our more differentiated positioning within the small and mid-cap space. So just to share more about how the merger and acquisition scene sort of looks like. So typically, the reason why this offers us very good optionality for upside return is also because if you take a look at some of these past examples of M&A activity that has happened within the portfolio, where we were able to benefit from some of these smaller names that we held that were eventually acquired by some of these bigger players. For example, if you take a look at how LinkedIn was acquired by Microsoft, what we were able to see was upon announcements of some of these acquisitions, what we tend to see is a very strong upside return from the company that's being acquired, simply because most of these larger companies tend to be paying a huge premium. And also because of that, this tend to be reflected in a very sharp one-day price increase. In this case, when Microsoft announced the news that they will be acquiring LinkedIn because of market optimism of the kind of synergies and optimism around this merger and acquisition activity, you saw how LinkedIn share price actually went up almost 47% just within a single day. So all these subsequent examples that are reflected here on this slide is going to show you how larger companies have been able to acquire some of these smaller companies. And these have traditionally done quite well for those holders or investors within the small and mid-cap space that has been successfully acquired by some of these larger companies. So if we just take a look at how this has translated into performance for the fund, so I'm quite glad to say that performance does speak for itself, and it is a reflection of how we have been able to deliver a very time-tested approach for investors. So other than the fact simply that we have been able to outperform the index and peers, I would say that where I would like to draw your attention is how we have been able to shine even during the most challenging of market conditions. So take, for example, like the year of 2022, what we saw was how tech stocks really led the market in the wrong way for that particular year. We saw how tech stocks sold off sharply with the index closing the year down around 27%. And I would say that our fund was able to cushion around 1/3 of the downside, delivering around -17, -18% for that particular year. And that was going to be down to how we were having a very strong valuation discipline within the fund, making sure that we are only buying into names that are trading at reasonable valuations, so that the sort of sell-off or downside risk that we operate on is going to be coming in lower than the peers, lower than the market. But I'll say also that this doesn't mean our valuation discipline lets us trade off in terms of how we are able to capture and also deliver growth returns for investors. So in the year of 2020, which was going to be pretty much a COVID year, what we saw was it was a very growth-driven market. We saw how growth stocks really just shot through the roof when central banks around the world did a very coordinated and concerted effort to cut rates and to really ease rates to sort of steer the economy out of the COVID crisis. So even in a very growth-driven year, despite the fact that we are being more valuation conscious than most of the peers and also relative to the market, we were able to return returns that were in line with the overall index. And that is really going to be coming down to how strong stock picking and also strong stock selection has always been a key differentiating factor for the fund. So maybe if I were just to speak a bit more about our year-to-date performance. So like I mentioned at the start, when I was sharing a little bit more about how the market has been performing, it has been an extremely narrow market, and it has been pretty much been led by your FANG Plus kind of stocks and also your direct so-called AI winners. So year-to-date, the fund is up 23%. While the overall index is up maybe closer to 31-32%. So I would say that the reason for this sort of a shortfall or the sort of a detraction or returns that has been left on the table is largely from the fund's lack of exposure to NVIDIA and also our underweight and lower exposure to Apple and Microsoft. And if we just look at it from a month-to-date perspective, so just in August alone, we have seen some retracement, we have seen some correction within the tech sector. And these decisions have actually helped the fund simply because the market has started to reassess their sort of optimism for some of these mega cap companies like Apple and also Microsoft, where we started to see how maybe investors were being a little bit too exuberant, a little bit too excited in pumping monies into some of these very commonly held names. So over the longer term, we have seen how this has pretty much been able to deliver very strong returns for investors. So on this slide, we are reflecting the returns of our fund in our US dollar share class. And since inception in 2014, we have been able to deliver annualized returns of around 17% for investors. And the overall investment journey has been pretty much smoother than both the market and also the peers, being at lower volatility and also taking on far less risk than our peers and also the broader market. So just to bring the strategy a little bit more to life as well, I would say that this slide offers some stock examples of how we are playing the different themes in tech. So some names that I will highlight will include within the AI space, we are not going to be chasing after the obvious winners. We are maintaining our sort of contrarian approach, our contrarian philosophy, by looking for those opportunities that remain underappreciated, looking for some of those second level beneficiaries that haven't run up that much. So that's where you're going to be seeing a name like Samsung instead of Nvidia or AMD up there. So within digitization as well, again, we are going to be finding opportunities that are outside of the tech sector. So for example, for those of you who may be familiar, a name like Salesforce, a CRM, a customer relationship management kind of system, this is going to be an example of one of the ways that we can sort of capture opportunities outside of the IT sector. And we're also going to be looking for players, for example, like Rolls-Royce is not just going to be $1 million car company, but in fact, it has been able to embed AI within its design of aviation products. So the next time you do take a trip out, take a flight out, if you look outside your window and you see the Rolls-Royce symbol spinning away at a turbine, that particular turbine design has actually been assisted in its development and design through the use of AI tools. So even within digitization, we are finding opportunities in industries such as aviation and finding industrial opportunities in industrial names as well. And this is also going to be very important and another area that we encourage investors to consider when taking a broader approach to tech investing. So something that is a bit more of a recent and emerging theme is going to be within the China tech build-out space. So this is another one of those powerful themes that we have identified in the near term. And what we are seeing is how China has been buckling down, trying to secure their self-reliance in science and tech. And this is where we have names such as ASMPT, which manufactures very essential components for AI. That is also going to be allowing us to participate in this overall theme as China starts to advance in terms of their R&D, starts to advance in terms of their self-reliance in science and technology. So if you pull our fact sheet as well, one of the common questions that I can imagine may come to your mind is going to be about how, for a tech fund, why is it that we look like we have an underweight to the information technology space? And again, this is going to be boiling down to how we are going to be finding tech opportunities outside of the IT space. So within communication services, while most of us may be under the impression that Netflix is parked under information technology, Netflix is actually parked under the communication services sector. And again, an undeniably tech kind of a stock that we should be participating in. So consumer discretionary, again, you're going to be finding names such as Alibaba over here. Within the financial space, we have seen how contactless payment is pretty much the go-to right now in many of the food courts out there, in many of the kind of e-commerce kind of behavior or experiences that we are facing in our everyday lives. So financials, we are going to be finding opportunities as well in some of these players that are participating in contactless payments. So within industrials, I mentioned Rolls-Royce, Uber. These are some of the industrial names where AI, where tech is actually embedded very much within their business model. And real estate is going to be representing how we are finding opportunities as well in those kind of companies that are involved in building up the infrastructure. So for example, when I speak about the sort of 5G story, what we know is that you're going to be needing a build out of some of your 5G receivers. You need some of your 5G towers as well to come on board. And this is where we are going to be participating in some of these opportunities, investing in companies that are involved in building out some of this infrastructure technology. So in terms of country positioning as well, if you take a look at our fact sheet, what you'll notice is that we are going to be slightly more diversified than most of our peers out there in the market. So we are not concentrated within the US like most of our peers would be. What you'll notice is that we do run an underweight in our exposure towards the US within our fund. And unlike most peers where they are running an exposure to US at over 80 to 90%, we currently sit at around 60%. So we do take a more global approach in trying to find winning companies all around the world when it comes to technology. So I would say within the top 10 holdings as well, again, the key point that I would like to highlight is how within the more crowded parts of the market, for example, the Facebook, Amazon, Alphabet, and the like, what you'll notice is that to our exposure within the FANG Plus names, we are managing our single stock weights very carefully to make sure that we are not overly concentrated. In fact, we are running exposure of or under 7% to each of these very commonly held names. So looking at the overall fund profile, some of the key details that I will leave you with is that right now, this is one of the largest fund out there that's participating within the technology team. Today, the assets under management within the fund stands at over US dollars 17 billion. And we do offer this in US dollars, Euro, and also Sing dollars. And for those who are investing in Sing dollars, of course, you can also tap on your SRS monies to be invested in this longer term theme. So if I would just end off on this particular slide over here, just to sum up with a number of key takeaways that I'll leave you with. If we take a look at the broader market backdrop, I would say that while the technology sector has seen an extremely strong rally, an extremely strong run-up, the key message over here is that it has been a very narrow market, and it's going to be quite important for investors to take a more contrarian approach, simply because these very crowded parts of the market have run up very tremendously. So those few numbers that I spoke about at the start, where you see how the FANG Plus names have returned about plus 61% year to date, and the S&P, if we strip out these 7 names alone, will be up just about 6%. Again, it's just going to be talking about how we think it's very important for investors to be looking outside of these crowded parts of the market to find those opportunities that are still trading at reasonable valuations for the longer term. And of course, as investors, we want to be anchoring our portfolios in themes that are going to be giving us longer term return potential. And I think it's quite undeniable that technology, while it's not going to be a new theme, it's not going to be the latest kid on the block, it will very much continue to accelerate. The opportunity will continue to accelerate as the speed and rate of adoption continues to chug along. And so it's going to be very important for investors to maintain that sort of core equity exposure that lets you participate in this longer term technology theme. So with this in mind, if you would like to start with technology investing today and you want to be able to express some of these views that I spoke about in being a little bit more contrarian, in making sure that we are focusing really on fundamental valuation when we are navigating a space such as this, then look no further than our Fidelity Global Technology Fund. We are going to be putting the TECH in technology investing. So bringing to you a time-tested approach, a fund that is backed by extensive investment resources. Think about Fidelity's research that is powering this strategy. And the C is going to be representing how we maintain that sort of contrarian philosophy in navigating the technology space to finding opportunities that are going to be otherwise underappreciated or overlooked by the market. And last but not least, making sure that as an active fund, we are going to be well diversified across the different teams, across the different sectors, and finding opportunities outside of just information like technology, finding opportunities outside of just the US alone to give you that truly diversified approach towards technology investing. So I do see a number of questions coming through in the chat. So let me just take the chance to end off my presentation over here, and happy to address any of these questions that you guys may have. Okay, maybe I will just bucket some of these questions that I've seen coming into the chat. So maybe the first one that I think again speaks very much to our fund's recent performance and also going to be reflecting the way that the market has been moving year to date. So this question is going to be asking about how is it that the fund's recent performance has been lagging the broader market index. So we have been returning, like I mentioned, we have been returning around 27%-ish versus the index, which is sitting at about 38% right now. So where is that shortfall coming from? So I would say simply put, looking at the gap that we are having versus the market index, 80% to 90% of this gap is explained simply by the fact that we hold 0% of NVIDIA. So we don't hold NVIDIA within the portfolio. And we hold less of Apple, Microsoft, and a lot of your other mega cap tech names that have run up quite a bit. So another question is going to be asking about why is it that we don't hold NVIDIA. So while we can all see how NVIDIA has rallied so very strongly year to date, so year to date NVIDIA has run up almost 220%. On the back of some of these AI hype, on the back of some of this market optimism around how artificial intelligence It's going to transform the way that we live. So if we take a look, NVIDIA run up about 210, 220% year to date. But if we take a look at 2022, just an example of how things could very well play out very differently. So coming into 2022, we saw how NVIDIA started the year close to $300-ish, and with the sort of risk-off kind of sentiment that came into the market with elevated geopolitics, with rising interest rates, with fears of a sort of a global recession. We saw how NVIDIA very quickly lost almost 2/3 of its market cap. We saw how the stock price sank to around the $150 range. So we have seen how chasing after some of these parts of the market where most of your people have bidded prices up to a very high level, where valuations have expanded to factor in so much of this optimism, it can also play out very differently, and it's going to be representing a very big risk within the portfolio. So I think this is going to be one of the fundamental reasons why we don't want to be following the crowd in terms of chasing up and buying into some of these names that have run up so very much. So that's going to cover our funds sort of lower returns versus the index on a year-to-date basis, but we continue to anchor ourselves to the sort of investment philosophy that has stood the test of time. So another question is going to be asking about our portfolio in terms of the number of holdings. So typically our fund would operate within a range of between 50 to 100 individual stock holdings. And right now we are sitting on the upper end of it. We are currently diversified across 100 holdings within the fund itself. And I would say, again, it's also because at the end of the day, being a unit trust, being a fund, what we want to make sure is that we are able to offer investors access to a team in a very diversified manner. We don't want to be running very strong single stock kind of a risk. And right now, the reason why we're sitting at the upper range as well is also simply because we are finding more opportunities that are trading at reasonable valuations outside of some of these names. And we had picked up on quite a few of these names when the market was selling off back in Q4. So again, it's going to be a function of how, when we were being a little bit more contrarian, when the market was selling out of technology back in Q4 last year, that gave us the opportunity to be picking up on some of these long-term winners at very good discounts, at very good valuations. And that has allowed us to build up our portfolio to the 100-odd names that you're going to be seeing right now. So that's going to be answering that question. And I see another very interesting question coming into the chat. So what is our exposure to crypto and also the decarbonization space? So I would say in terms of crypto, we are definitely not a Bitcoin fund. We are not a digital asset fund. So we don't hold any investments within Bitcoin or any one of those other digital asset or cryptocurrencies out there. So we don't hold any of these. But of course, when we take a look at crypto, there are also a number of ways that we can play this. Other than just buying up some of these digital assets, we can also buy into the technology itself. So I would say right now, in terms of the underlying exposures, we are choosing to participate maybe via our exposure to the broader semiconductor space. So some of these companies that are going to be very much involved in delivering some of these components that go into improving and enhancing computing power. This is another way for us to play the space without directly owning it. Decarbonization, again, going to be a factor of how we are going to be looking for opportunities across the industrial sector, within the energy sector. So a classic example would be a name such as Baker Hughes. So for some of you who has dialed into the webinar and maybe involved in the oil and gas industry or the energy sector, what you'll see is how Baker Hughes has started to build a name for being able to deliver sort of a digital based solutions that will help companies streamline and also improve the efficiencies within their businesses. So being involved in sensors, being involved in some of these digital solutions to enhance efficiencies, I would say that this is another way that we can give exposure to the broader decarbonization theme. So let me take a look again at some other questions that have come through. Okay, this is also another interesting question, and I think it's related to smartphones and PCs being saturated. Okay, I would say that this is also going to speak a little bit more about the overall market cycle. I think what we all know is that smartphones and also PCs tend to be a little bit more cyclical. They tend to be a little bit more linked towards the overall economy. And so typically, as we hit into a sort of a global slowdown, or when the market is starting to price in a bit more of a recessionary fear, what you tend to see is how some of these more cyclical part of the markets have actually been selling off quite a bit. So the smartphone space is actually quite interesting. So one of the areas that we have seen, or rather one of the trends that we've been seeing, is how the replacement cycle for smartphones and personal devices today has started to be a little bit more elongated. So I would say back then, if we take a look, just look no further than our own experiences here in Singapore. I think once upon a time when we were working with our telcos and working on our telco plans, you're typically be seeing how people operate on a sort of 2-year replacement cycle when it comes to smartphones. And right now, what we're starting to see is how, I mean, myself for one, I did hold on to the iPhone 12 for quite a long period of time, but eventually I've seen how we have been able to. I eventually went up to upgrade myself to an iPhone 14 when we couldn't be keeping up with the sort of computing demands of the operating system and software. So when we take a look at the smartphone space right now, what we're seeing is that no doubt the cycle has extended, but it does look like right now we are approaching the sort of trough. It looks like we are at the start of a new smartphone replacement cycle. And I think this is going to be a very interesting area of opportunity for us to take a look at. So another question is going to be about, let me just take a look and scroll through the number of questions that have come through. Okay, another question is with regards to the minus 20% of the fund's performance in 2022. So again, if I were to flash back to that particular slide, like I mentioned, 2022 was pretty much a challenging year for most asset classes. So global equities would have closed the year at about minus 18%. So not just within the tech sector alone, just looking at the broader equity market itself. Global equities closed the year about minus 18. And on this slide, we can see how the IT index, which is going to be representing companies around the world that are within the IT sector, it shed almost 30% in that single year alone. So our fund, likewise, we wouldn't have been immune to the broader market effect, but our valuation discipline, our stock selection has allowed us to cushion about 1/3 of the downside in such a challenging market environment. So just to also put that into context, I would say that one of the key reasons why most equities would have sold off in a year like 2022 was really from the sort of rate hike cycle that we saw, where we saw how central banks around the world were very aggressive in taking rates up very quickly. And as a result of that, you saw that sort of de-rating, that sort of contraction in valuations within the tech sector. So I would say that it's just not going to be, it is going to be a sort of a negative return year for the fund. But making sure that we were able to offer that sort of cushion, mitigating some of the downside, is going to again speak to the valuation discipline of the fund. And looking across market cycles and looking across investing in tech for the longer term, we have been able to see how even with that sort of challenging drawdown in a year like 2022, overall returns are still pretty much consistent in the way that just looking at it across the track record of this particular share class that I'm showing on this slide over here, since 2014, annualized returns of around 18% for an investor within a fund. I think this is again going to be speaking about how we can navigate and also react to different market cycles. Okay, let me just take a look at whether I can spot any other new questions that come about, but thanks very much for sending across all these questions. So I see another question to do with ESG. So I would say that in terms of ESG, so for the benefit of the wider group as well, so ESG refers to environmental, social, and governance factors. And this focus on sustainability is something that's pretty much been emerging in the recent years. So I think this particular question is related to how we are adopting ESG within the fund itself. So I would say that at Fidelity, we do have a few firm-wide exclusions within and across the funds that we operate. So within Fidelity, we would be excluding some of the more controversial sectors. So for example, companies that are involved in controversial weapons, cluster munitions. These are places that we would have standard exclusions operating within the fund itself. But something to highlight is the fact that this Fidelity Global Technology Fund, it's not a sustainable focused fund, which also means that we will not be running, for example, if you look across the market, you may come across some of your other funds out there that are branded as a sort of sustainable fund, for example, a Sustainable Asia Equity Fund. So these funds have a much stronger focus on making sure that they are concentrating and focusing on sustainability factors. So we don't apply those sort of constraints within our portfolio. But with that said, we do have a number of standard exclusions applied to within the fund, simply because Fidelity as a firm, we do also run some of these standard exclusions to make sure that we as a firm are doing right by some of these ESG factors and making sure that we are also incorporating some of these considerations within our business, within our asset management business. Thanks very much for the question. Okay, and in terms of the themes, a couple of questions related to themes as well. So I would say that this slide really does capture some of the areas of opportunities or some of the themes that we are looking to express and participate in. So for example, 5G, nothing new. Artificial intelligence, preferring to play it via some of these names that have not run up as much. And maybe something that's interesting to share again when it comes to artificial intelligence is also, while the fact that we are not chasing after some of these direct beneficiaries, such as NVIDIA, another way that we were being quite contrarian in the way that we were playing the artificial intelligence theme was to look at some of these parts of the market that had sold off simply because people thought that these will be names that would be disrupted by AI. So what we saw with the launch of ChatGPT was how markets started to talk about how some of these businesses that are involved in content creation, for example, within the music industry, this could eventually be disrupted simply because AI may replace what is commonly generated or created by human artists. So some of these content creation names or names that are involved in parts of the market that people viewed may be disrupted by AI had actually sold off quite significantly. So we took advantage of that sell down simply because we felt like if we look at the music industry, particularly within the digital streaming space, this is going to be a structural growth factor because we are going to be seeing continued digitization, continued demand for digital ways of consuming music. So that was another way that we could play on the AI theme. We could go after some of these names that have sold off very dramatically, pick them up at a good discount. And when the market starts to factor in more of these long-term growth, names start to appreciate it a little bit more for what it is. This gives us quite good return potential on the upside. So another way that we were able to play the AI theme very differently with a sort of contrarian mentality. So let me just take a look at some other questions within the chat. Okay, I see a question related to our top 10 stock holdings. So a question with regards to Ericsson. So I would say that the investment thesis for Ericsson over here is that we park this under our sort of special situations bucket. We believe that Ericsson is an example where, to your point, you have rightly observed that Ericsson is a name that has been beaten up quite a bit. And we do think that this is a name that gives us the sort of optionality as and when the management is able to execute the restructuring of the business, as they're able to optimize their business, we should start to see some of the value come back into the stock itself. So again, within our portfolio itself, I'm going to mention that it is going to be a blend between long-term winners, opportunities in the shorter term that are a result of the way that market has been moving, and last of all, within the special situations bucket that are more idiosyncratic, that are more focused on company-specific opportunities. So I would say that Ericsson falls under that last bucket that I spoke about, where we do believe that the kind of restructuring efforts that are underway by the management, when our analysts is speaking and engaging with the management of Ericsson, and we're seeing how some of these restructuring efforts are going to be playing out over the coming years, this is going to be giving us quite a good expectation for return looking ahead. So I would say that this is really the investment thesis for it. Not chasing after those stocks that have run up, but making sure that we are also giving investors exposure to some of these parts of the market where we see good return potential in the longer term. Okay, and I would say that another question that has come up, and I will choose to bucket this. A couple of them are related towards China. I would say that over here, looking at the way that the fund is approaching this sort of theme, the first one would, of course, be the US-China sort of tensions. So what we are seeing also is the fact that this has actually motivated China to spend quite a bit of R&D, quite a bit of capital expenditure to build up self-reliance within this space. And I would say that this is going to be the reason why we have identified this as one of the key themes within the portfolio, and why you are going to be seeing some of these names that are related to this sort of theme expressed within our portfolio as well. So within the space of US and China, I would say that this is going to be something that is more political in nature. It's not going to be something that I'm going to be commenting on from a political point of view. But I would say that, again, it's going to be important for us as investors to make sure that we are going to be well diversified, making sure that in periods of market volatility such as this, we are not just concentrating all our eggs within a single geographical position. And that's also one of the reasons why when you take a look at our country exposures, it's not just going to be 80 or 90% focus on US names. It's not going to be a huge kind of exposures of 9 to 10% within a single name itself. But in general, our single stock names, if you look at our top 10 holdings right now, each one of them is well under the 6 to 7% kind of range. So I think that's going to be something that we will be able to offer investors as well, especially in the case when you're choosing to express your investments in the tech space through a longer term kind of a fund such as ours. Okay, and maybe just the final question that has come in is about whether or not this is an ETF. No, this is not an ETF. This is a mutual fund. This is a unit trust. So this is not listed on the brokerage, but Poems does offer this on their unit trust platform, and it's something that you can invest in. And do feel free to reach out to your Poems advisor if you are keen to invest in this fund. Okay, and with that, maybe I see that we have come up to the top of the hour. Jocelyn, maybe if I were to hand the time back over to you. Thanks very much to the rest of you who have taken time off the call. I hope this has given you some good insights into the tech sector, and wishing all of you a very hot and good year ahead. Thanks very much.
Thank you, Leonard. So we have come to the end of the webinar, and we'll be sharing the follow-up email soon. So do keep a lookout in your inboxes. And we hope to see everyone again soon. Thank you.
Thank you. Thanks, everyone.
Thanks, Leonard.